Good morning, ladies and gentlemen. It's time for another podcast with yours truly, the Algo Capitalist, aka the Vulcan, coming to you live from postwavetrading.com, home of the world famous post wave price trigger reports. And let's take a look quickly, snapshot of these markets, and then we're going to get into today's discussion. All right, so if you take a look, I don't know if you can see these quotes, it's quite small, but so far we got the Bitcoin futures down 1,725 points or $1,725. It is to be noted that Bitcoin is still in the neutralized position, so no trade recommendations for that one coming into today from last night. Looking at the Ethereum futures down $129.50 at $1,875. Now, coming into today on this one, we weren't looking to buy this one just yet, even though it has a rally alert on it. It did not reach the intraday price inflection point for a buy. So this buy signal was not confirmed, was not triggered yet anyway. As far as any sell side, that there is no sell side for this one. It's this market is in a bear market retracement and therefore well off its support zones for entry. Taking a look at crude oil this morning, quite substantial rally off of the $62 price floor. We've rallied almost $10 from that. Actually, we have rallied make it $11 from that floor. Right now, crude oil futures are up $1.81 a barrel at $73.15 a barrel. Now, coming into today, there was a rally alert that we issued on Sunday for this particular market. It has triggered the intraday price inflection point and has moved. It earlier this morning it was almost $2 and an upside profit potential. Right now, the market's pulled back a little bit, but it's still above the intraday price inflection point. Taking a look at nat gas. Nat gas is up 10 right now at $2.24. Now, coming into today, you've heard me talk about nat gas in the end of day reports. It is in a situation where it's locked in this bear market, but it's neutralized for today. Even though it has a rally alert, it is neutralized for today. So this one you would be standing aside until you get off of neutralization. Taking a look now at gold. Gold's up $8.70 an ounce at $2,033.30. Now this one is in a bull market, of course, but it has a bear market crash alert associated with it for today. So far, the market has not given you any downside production, so that has not been confirmed yet. Taking a look here at silver. Silver is off 8 cents at $25.85 an ounce. It also had a crash alert coming into today. The market has not triggered the intraday price inflection point for that short to be activated. So we have no downside production to speak about at this time. Taking a look here at copper. Copper is up, trading at $3.92. As far as copper is concerned, copper has been in a bull market. And so we're looking for a continuation pattern topside today, which the market has given. It has triggered the intraday price inflection point for a buy, and the market has now moved in position, giving you upside production on that one. Looking here at the Dow. The Dow right now is down 84 points at 33,656. Now, it is to be noted that the Dow futures is in a bull market, but we have a bearish trend momentum reading. So we were actually looking for this one to pull back. And so far, it got close to triggering an intraday price inflection point short, and it's still on watch. It's still on alert for that. I think the market is probably going to trigger that today, so we'll definitely be watching for that. Looking at the S&P 500, it's down 2.75 points at 41.47 and a quarter. Coming into today, this one's in a bear market as well. We're looking for a continuation pattern to the downside. This one has not triggered an intraday price inflection point short yet, so we're still waiting and watching this one as well. The Dow is closer to triggering, though, it should be noted, than the S&P is at this point. Looking at the NASDAQ futures, it's down 28 points at 13,288 and a half. Now, the NASDAQ coming into today is in a bull market, but it has a bearish trend momentum reading as well, and it has not triggered an intraday price inflection point to the downside either, but it is not far off. So we'll be watching that one to see if there's any downside production given. And then here, taking a look at the Russell, it's down 11 points at 1754.40. And it's in a bear market, but it had a rally alert coming into today. It did trigger that rally alert. It did trigger the intraday price inflection point, and it's since pulled back from that. All right. So that is a snapshot of what's happening currently in these markets. However, what's happening in the economy is not so good. I'm hoping you guys really had a nice weekend, because if you did, then that means you're coming into today nice and relaxed. All right, so as we're taking a look here, just bear with me for a moment because I'm watching markets while I'm doing this. Let's see that. Give me just a second. Just a second. Need to take a look at something here. I think we're about to see some interesting things develop, and I would like to see where this takes us. All right. I think that some more news is yet to come out, and we definitely don't want to miss out on that. And we're going to go over that in just a second. I'm just checking on something here. Just bear with me. Bear with me just a second. All right. Give me just a second. Just need to map something quickly. All right. All right, so that's that. Got one more thing I need to do. Bear with me. Almost done. Let's see here. Let's see. Hold on one second. All right. Need to put on hold for just a second. Pardon my silence, just another moment. All right, ladies and gentlemen, sorry about that. I had to deal with something here in the background. All right, so the issue that I want to talk about and discuss today is how the powers that be have decided to deal with the economy. Now, going back to 2019, it was apparent that there were some financial issues that needed to be addressed. And we're not sure why they weren't being addressed at that particular time in the past. We know now with that, with hindsight being 2020, we know exactly why a lot of the issues were kind of suppressed and not being talked about. But you have to ask a question now, and I ask this question a lot. The question that I ask is the members that make up our government, are they incompetent or are they evil? Because if they're incompetent, then they should be removed from office immediately. But if they're evil, then all the more to remove them from office with haste. So we have to ask, the response to the 2020 crisis, we know at the time that it was a mistake. But now looking back 3 years later, we know that it was a monumental, catastrophic mistake to shut down the global economy, the ripple effects of which we are still yet to really fully experience. So, the question you need to ask yourself this morning is the Federal Reserve trying its best to cause an economic depression? Are they trying to destroy the United States of America? Well, you have to say it's looking like the answer to that question is yes. I mean, look around. The US banking system is collapsing. The commercial real estate market, well, it's imploding. Home sales are plunging, and large companies are laying off workers all over America. And as far as the home sales situation goes, the the peasantry are not buying homes, but large corporations are doing their darnest to snatch up as much residential real estate as possible. We know that the elite have also been purchasing a lot of farmland. The Federal Reserve, apparently, based on its actions, has decided to raise interest rates even higher. They did this on Wednesday. But let's be honest. Let's speak candidly. This is nothing less than economic malpractice. They know that higher rates are crushing the economy, but they apparently believe that more pain is needed. Officers at the Fed just hiked rates another 25 basis points, and they are now the highest that they have been since August of 2007, a year, 12 months before the unveiling of the 2008 financial crisis. That's right, ladies and gentlemen. The Federal Reserve this past Wednesday raised its benchmark interest rate by a quarter of a point. However, that also opened the door to a long awaited pause in the most aggressive tightening campaign since the 1980s. Now, the unanimous decision puts the key benchmark federal funds rate at a range of 5% to 5.25%, the highest since August of 2007, from near its zero a little more than a year ago. Now, this marks the 10th, not the ninth, not the eighth, not the seventh, but the 10th consecutive rate increase aimed at combating high inflation. And you know how they really want to combat high inflation? By you losing your job. When the Fed raised rates that high in 2007, it didn't exactly work out so well, now did it? The next year, we plunged into the worst economic downturn since the Great Depression. Now, a new economic crisis has begun, and even CNN is admitting that higher rates will make things even worse. Meanwhile, investors are still coming to terms with the rapid run up in rates, which sparked a huge sell off in U.S. government bonds and stocks last year. Banks that failed to adequately prepare have been hammered. The shifting landscape paved the way for the collapse of Silicon Valley Bank in March and First Republic Bank this week. Now, more pain could be on the way. The commercial real estate sector, which is very, very sensitive to high interest rates, looks particularly vulnerable. Its problems made worse by a glut of empty office buildings in the wake of the pandemic. Now, in particular, higher rates will put even more pressure on hundreds of banks that are already teetering on the brink of insolvency. This is why they relaxed those banking guidelines and said, oh, you don't need to have that much reserves. Don't worry about it. And when banks are struggling to survive, they get really tight with their money. And that's why we are now facing a big time credit crunch. That's right, they're reining in all the credit. Now, this data suggests a credit crunch has already started. Morgan Stanley analyst Mike Wilson said during a recent episode of the firm's Thoughts on the Market podcast, during a credit crunch, banks significantly raised their lending standards, making it difficult to acquire a loan. Borrowers have to agree to more stringent terms like higher interest rates as banks try to reduce the financial risk on their end. Fewer loans, in turn, would lead to a less big ticket spending by consumers and businesses. If the goal of the Federal Reserve was to curtail economic activity, what they had already done is already working. So there was no need to hike rates even more. Just look at some of the things that have happened over the past couple of days and couple of weeks, for example. FedEx Freight has announced that they will be permanently closing 29 locations. FedEx Freight is closing 29 locations later this year and will begin another round of furloughs for some employees at the end of May. The company announced this on this past Monday. FedEx Freight plans to close the locations and consolidate its operations into other locations effective August the 13th. When asked about where the locations set for closure are, a FedEx spokesperson said the company did not have that information to share at this time. And Vice Media has announced that it is preparing to file for bankruptcy. Vice Media is preparing to file for bankruptcy after attempts to find a buyer for a company once valued at $5.7 billion appear to be going nowhere. More than 5 companies have expressed interest in acquiring Vice, the New York Times reported on Monday, but the chances of a sale are seen as increasingly remote. The decline of Vice comes a little over a week after BuzzFeed News announced its closure, and 3 months after Vox laid off 130 people, representing 7% of its staff. Even GM is feeling the stress of the economic environment. According to USA Today, earlier efforts to reduce their workers were not sufficient. And so they will be giving the axe to the hundreds of contract employees. General Motors terminated several hundred contract employees who worked at its Global Technical Center in Warren, Michigan, and other locations in its bid to shave $2 billion from its budget by the end of next year. The cuts come nearly a month after 5,000 salaried employees agreed to a voluntary separation package that GM said would help it achieve close to 50% of its cost cutting target this year alone and prevent further involuntary cuts. Meanwhile, more retailers continue to go belly up. Yeah, you got Target, you got Best Buy, you got Bed Bath and Beyond, you got Tuesday Morning. I mean, I can't keep track with all of the retailers that are in trouble. Do officials at the Federal Reserve not understand what is going on out here? It's a bloodbath. And they just made things even worse. They just poured jet fuel, diesel fuel, lighter fluid on an already 5 alarm fire, saying, "Oh, we're going to put the fire out by adding more accelerant. We're going to put the fire out." And it isn't just that, but economic activity is rapidly slowing down all over the world. And officials at the Fed have chosen this moment to sabotage the central hub of the entire global economy. If we plunge into an economic depression, and by some measurements we already are there, the entire planet will feel the pain. People better start hoping for a miracle from somewhere because economic conditions are deteriorating a little bit more with each passing day, and officials at the Fed have made it abundantly clear that they do not plan to help us. This is where we find ourselves at today, ladies and gentlemen. So you need to ask yourself a question. Is your government incompetent or evil? And it should be noted that the Federal Reserve is not a part of the U.S. government. It is a privately held corporation. Now add that to it, and we have a messed up situation going on right now. So, ladies and gentlemen, I just wanted to address this elephant in the room called the Federal Reserve, and to take a look at its actions this past week. And as you can see, moving forward, the catastrophic consequences that are going to follow. All right, ladies and gentlemen, that is it for today's podcast. Thank you for tuning in. And in our next podcast, we will take a deeper dive into the economy and see what other things are sticking their noses up and what other uh, green shoots are trying to poke through the ground. And when I say green shoots, I don't mean the edible vegetation. I mean the toxic vegetation, the stuff they don't want you to know about and see. But we're gonna take a look at it. Meanwhile, keep an eye on these markets because I believe that the next leg down has been set up and the market is about to go there. You know what this is. Smash the like button. And until next time, be encouraged. I'm out. Peace.